If you want to understand velocity banking for a mortgage using a line of credit, this is for you. More importantly, we're going to go into multiple alternatives so you can see that there are alternatives to velocity banking, and we're going to show you what a couple of them are and how they stack up and compare them so you can compare them. I always start by saying government doesn't care about you, banks don't care about you. It's up to you to take control of your financial future. Real freedom is financial freedom, and I believe if you can transform your finances, you can really transform your life. So if you appreciate this video and the time I put into these, please smash that like button and subscribe so you see more of these. Now, one thing I want to point out is that back in April, I did a video regarding velocity banking and a mortgage. And I gave an alternative at the end, which was making extra principals on a mortgage, and we'll go over that. But that video didn't explicitly state that that's what I was doing, so I think some people may have missed that. And more importantly, I want to point out that what I do in my videos is I teach a method, not the method. In other words, if you watch one of my videos, don't think that what I'm saying is this is the only way, this is the best way, and this will work perfectly for you. No, I'm just trying to teach methods, knowing that, for example, in this one, if you change any of these numbers, such as a percentage rate, it's going to change everything. So when you watch my videos, say, okay, I'm learning one method, I'm going to plug in my numbers, and I'm going to see how it works for me. And then I might try another method. Because like I did, this is June, and I believe a week ago, I put out a video, actually maybe it was yesterday, regarding opportunity cost. Because I get so many comments about people saying, that's not the best method, there's alternatives. And I think, oh my goodness, I'm not making myself clear. All of these videos teach a method. And I don't have time in every video to go over all the other methods. I put out over 200 videos. In credit card reduction, I think I may have done, 20 or 30 with different methods of reducing your credit card debt. Doesn't mean they're all going to work for you. So opportunity cost simply says, if you're going to use this method, then you can't use this method. So make sure you evaluate them all and see what works best for you. So I hope you find these helpful. And that's why I'm going to explicitly state in this video that I'm showing alternatives so you realize there might be alternatives for you. And we'll go over pros and cons at the end. So let's get into velocity banking, really simple explanation, and how it works, and then the alternatives and compare them. This is the video I did the other day, and it is a 30-year mortgage at 7%. I try to keep nice round numbers. I'm just using principal and interest payments. I'm not throwing in the fact that there's other taxes and things involved, PMI, stuff like that. We said, what if you bought, and this is the average price of a home, $420,000 home. And here's the simple mortgage. You put 5% down, roughly $20,000. So your mortgage is for $400,000. In this example here, same numbers, $420,000 house, $20,000 down, $400,000 mortgage. Okay, these two examples, same mortgage amount. In this case, you've got a payment of $2,661. And for 360 months, or 30 years, you make that payment. What happens at the end? How much have you paid? In total, you will have paid $958,036 in payments. The payment times 360. You also put $20,000 down. So $958 were your total payments, plus the $20 you put down. Out of your pocket came $978,000. Okay, that's a standard mortgage. Now, we use this velocity method, and I'm just showing not the full method of going and doing it over and over and over and over again. I'm just doing one iteration to show how it works. The iteration is in the very first month, what you did was you put a $20,000 payment. We'll talk about where that comes from in a minute. It gets you to $380,000. In other words, it drops your balance to $380,000. Your mortgage is technically still a $400,000 mortgage. You just made a quick principal payment of $20,000. It drops it to $380,000. What did that do for you? Well, at the end, your total was $819,000, $454,000. So you can see the total payments are less. However, you added in $20,000, right? Because you made a $20,000 payment. You also made a $20,000 down payment. So in this example, you took your $958 plus your down payment of $20, and you came up with $978. In this example, you take your $819 plus your $20 down payment plus your extra payment, so that's $40. $819 plus $40 is $859, $454. Okay, second part, and then we're done with this method. Where did $20,000 come from? Well, Velocity Banking says you get a line of credit. In this example, we use a line of credit at roughly 14%. And you take your $20,000 line of credit and you use that as your down payment. Essentially means you now have a loan at 14% that you have to pay off. And we explained the method of putting your income in, using it for your expenses. Bottom line is you have to have extra money every month. In this case, $1,000 a month was our example, extra to pay down this loan. You can go back and watch that entire video, but at the end of the day, what it means is this $20,000 loan ended up costing you about $3,000 in interest. Okay, so if you use this extra 20, it costs you an additional $3,000. So we're going to add $3,000 to this. Why? Because we're trying to get the total cost of this method. So the total cost of this line of credit using $20,000, paying off $1,000 a month, we just did it once, one iteration, is $862. And we're comparing that to $978. So this is going to save you money in the long run. Okay, now we've got our two methods, with one of them being $978 and one being $862. But what else could you do? So now I'm going to show you a very simple alternative, and then I'm going to show you a couple more real quick, and then we'll evaluate them all. So remember, you put an extra $20,000 in the velocity method using a line of credit. So what we're talking about is having an extra $20,000, and we paid that down because we had an extra $1,000 a month. For example, your expenses are $5,000, your income after taxes and everything is $6,000. You've got an extra $1,000. That's how you were paying this down. Well, if you've got an extra $1,000, you could just send in every month, and I've got videos on this, it's really straightforward. You just pay an extra $1,000 over your payment. That goes directly to the principal. None of it goes to interest. Okay, so we've got apples to apples, $420,000 home, $20,000 down, $400,000 mortgage, just like these. Your payment in these examples was $2661.21. It's $2661.21 because it's just the standard mortgage. Then we're going to add $1,000 a month, but only for the first 20 months. Why am I doing that? Because in this example, we used the $20,000 LOC just once. We did one iteration, just to make it simple without going through the entire thing. So we're just doing that for the first 20 months. So your payment would be $3661. Okay, what does that mean? Well, when we're comparing these, we said, okay, well, here are the total payments of these loans, $958, $819, and then we added in the extra 20, and then we added in the extra 20 and 20 and 40, and we got the total. So over here, your total payments at the end of this would be $845, $863. You added $1,000 a month for 20 months. You added $20,000. The total that you will pay out of pocket is $865, $864. Great. Now we know we've got $978, $859, and $865. Now, before we get to some other examples, let's compare these two. In this was the basic mortgage, and in this one, we added another $20,000 to our payments, and in this one, we added another $20,000 to our payments. Why are the numbers different? $862 and $865. Did I draw the line there? That's incorrect. We're comparing total out of pocket. Why? Because in this case, you put the $20,000 towards principal on the very first month. In this case, we added $1,000 a month, which means this one was $20,000 in month one. And in this example, it was only paid down $1,000 in month one. But then month two was another $1,000. Month three, another $1,000. All the way down to month 20, another $1,000, and then we stopped. So you reduced your balance in the first month to $380. In this one, you only reduced your balance $400 minus 1 to $399. Of course, you've got a payment there, so it's a little less than that, but you get the idea. instead of going directly to 380. So now this one in month 2 is calculating interest on 380. This one in month 2 is calculating interest on 399. A higher balance, more interest. That's why this method beats this method, but only by $3,000. So, and we'll talk about pros and cons in a second. So let's look at some of the alternatives, but hopefully you can understand that when it comes to velocity banking or any of these methods, the only thing you're doing, you have to pay back the principal. So the only thing you're typically doing is just trying to manipulate the interest. And by getting a lower balance faster, you're going to have less interest. Okay, now we'll show some more alternatives. So I'm going to go over one more alternative, and then let's compare and talk pros and cons. Another alternative, since the other methods we talked about an extra $20,000 lump sum or an extra $1,000 a month for 20 months, $20,000. Apples to apples, we're saying we've got an extra $20,000. Well, what if you said, I'm not doing any of that stuff. I'm just going to stick it in the bank, or I'm going to get a U.S. Treasury, and I'm going to get interest, and that's going to grow. What if I just did that and just saved my money? Okay, let's assume you get 5% in this current market. I guess you could get a U.S. Treasury. I think it's around 4.5 or 5%. Of course, you could buy some stocks with dividends, or you could do all sorts of things. And then I just threw in a tax rate, because of course you're going to get taxed on your yearly. Now, dividends are taxed differently than the percent you're going to get out of the bank account, but I've got videos on the difference between dividends and all of that. But let's just say you're going to get a 25% tax. Now, here's what I did. When we said we were going to pay an extra $1,000 a month for 20 months, instead of 360 months, it actually would only take you 311 months. That's 26 years. So I said, okay, we're going to compound this for 26 years. You're getting 5% interest, 25% tax. Now, just like I always say, you change the numbers, things can change greatly. You make this go up or down, you make this go up or down, it's going to make a big difference in what you're saving. But in this case, I think that's fairly conservative for the time, or at least maybe average. You're going to end up with $51,812. Great, so what? So, since you did nothing, this is our chart and our total payments for each of the methods. The total payments for the normal method was $978,036. Okay, $978,036, but we saved our money and we ended up with $51,812. So let's subtract it, right? Because we have extra money. So, and if you did the normal method and you saved money, you would only end up out of pocket being $926,224. That's what I put down here, this method. So let's walk through them. Here we are. Our normal method came up with $978,000 in payments. 20 months of an extra principal payment of $1,000 came out to $865. A $20,000 line of credit paid immediately was even lower, $862. We just showed that on the other screen. But if you said normal plus a 5% savings, which we just did, we came up with $926,224. So this method wins, but not by much. And remember, changing percentages can make a big difference, particularly with this method, but it gives you an idea, and I wanted to point out a couple things. There isn't any perfect method. There's different methods, and they work differently for you. Let's talk pros and cons. I went, after a divorce, through having to pay off a lot of debt. I've got 3 kids. I have expenses that come out of nowhere. So when I was paying off various types of debt, I tried to give myself as much leeway as possible. So let's talk about the fact that if you get a line of credit, you're going to have a minimum payment. Or if you get a personal loan, you're going to have a minimum payment. If you miss that minimum payment in any given month, it's going to hurt your credit. It's going to cause problems. So you're obligated to making that payment. And we were doing $1,000 a month, whatever the minimum may be, for a certain period of time. You can't miss that. The method where you're adding and you're taking that extra money and adding it as a principal payment every month, in that method, you don't have to do it. The bank doesn't care if you send them an extra $1,000 or not. So, in any given month, if kid 1 has a band trip fee and kid 2 has a football fee and kid 3 also has a band trip fee, and that's exactly what would happen to me, well, all of a sudden, I can't make an extra $1,000. Maybe I'll make an extra $500. 3 months later, Tires. Oh man, I do not like tires. I have no idea why tires are so expensive. Every time you get tires, it's like $1,200, $800, $1,500. It's unbelievable. And in that month, if you got to have tires because you got a hole in one and the tread's wearing through, well, you're not going to make that extra payment. But that's okay because that's an extra principal payment. So that just gives you an idea of some of the pros and cons of these various methods. Is that think about also what you're locking yourself into. Are you locking yourself into something you have to do, otherwise there'll be negative consequences, or something that you can do and you can stop doing it if you need to? Because I have videos on budgeting, but also videos on how to make, when it comes to your emergency expenses, your emergency savings, I should say, how to make that last longer. Well, one way to make it last longer is by not obligating yourself to things. So if someone were to lose their job or whatever it may be, and you can't make that extra payment, you just stop making it for a while. So I hope this was helpful to explain and go over velocity banking just very quickly again, pointing out that what you're manipulating is interest, and that every method's different, and that there are alternatives like extra payments or saving your money, and there's many other alternatives. So thank you for watching. I would greatly appreciate if you smash that like button so we can get this to more people, and comments on the methods or what you see are always greatly appreciated. Hope this has been helpful. Have a great day.